Our next guest is bracing for a really messy time in this market. Michael Schumacher is Wells Fargo's head of macro strategy. Michael, great to have you with us. Your note was really interesting because within it, there was sort of a debt ceiling playbook where you took a look at what happened, particularly with the bond market and in past debt ceiling periods. And you did find that there was a bid for longer duration, correct? So is that part of what we're seeing today?
I think it is, Melissa. And in our view, at least at Wells Fargo, Janet Yellen's note yesterday that, hey, the debt ceiling could be a problem as soon as June 1st, it spooked a lot of people. So what do? They look at what happened in 2011, the really bad case, and say that was risk off in a big way. S&P was down 15% in a couple weeks. Treasury yields, including the 10-year, went way down. Let's revisit that. Let's take risk off the table. Let's buy some bonds. I think that's a lot of what's been going on in the last 24 hours.
It's Karen. Thanks for being on, Michael. Do you think that any of the economic data, which looked a little bit softer, do you think that we're getting some sense of a recession in the last couple of weeks? It seems like maybe a soft landing is a possibility. What do you think is going to happen?
Not there yet, Karen. When you look at the data, yeah, it's turned a little bit, but I suspect we'll get pretty strong data on Friday with respect to the labor market. Yes, things have weakened. JOLTS weakened. I get that. But in terms of the things that policymakers really focus on and most reviewers look at, inflation, unemployment, they're still pretty darn good. So no really visible sign of recession just yet.
One thing that I've been struggling with is trying to compare the debt ceiling now with what happened in 2011. 2011, we were also in the middle of a European sovereign debt crisis. And so when I think about the move in bond yields in 2011, how much of it was the problems we were facing here at home versus a flight to quality that maybe was global, Europeans wanting to get into U.S. Treasuries? Have you been able to parse which is which, give attribution? And without that in Europe going on, how big a move do you think we could see in Treasuries now? Do you have any thoughts on that?
Yeah, it's really interesting. When you think about 2011, yes, Europe was blowing up. Italy, 10 years, traded at 7% for a while. But when you look at these historical periods, whether it's now versus 2011 or some other time, there's always something different. So today, what do we have? We've got regional banking problems. Didn't really have those back in 2011. So do those outweigh Europe for the U.S. investor? I'm not really sure. So it's tough to try to separate those effects. As far as how much yields could move, could the 10-year Treasury yield fall 25 to 50 basis points if things got really rough? Absolutely, we think it could. Is it super likely? Maybe not, but that could happen. So I think it's difficult to distill those effects, but thinking about that 80, 90 basis point move back in 2011, half of that, two-thirds of that, could that happen again? Yes, we think so.
When you think about what the Fed might do and the path it might take, so beyond tomorrow's decision, does any of this factor in your mind, Michael, or is it just the data and what you think the Fed wants to do?
Yeah, the Fed's in a tough spot. So the Fed now has the debt ceiling, which cropped up. It's a political event, not something the Fed can really influence, and yet it does impact Fed policy. So that's one thing. As far as banking troubles, to what degree is the Fed maybe a little bit responsible, which is some of the tone that came out of the Silicon Valley assessment, and the huge increase in interest rates contributing to that, it's tough to say. So the Fed's not completely a bystander in that case. But I take the point. The Fed's got a lot of crosswinds to try to assess. So in a full-blown banking crisis with the Fed hike, no, that doesn't make a lot of sense. But if the debt ceiling is becoming a little bit more intense or perhaps a lot more intense, would the Fed go one more time? I think it probably would. And then perhaps signal, hey, we've done a lot. Inflation's still out of control. It's coming down, though, but it's well above our bounds. We want to see it give a bit more time to the rate increases we already have in place. I think that's probably the messaging the Fed would like to get across tomorrow. It's going to be a really tough job, though.
We know the Fed has said in the past that it doesn't care what the stock market does, and I get that point. But at the same time, when you see how some banks have traded today, I don't know if there is a full-blown banking crisis in reality, but the perception is that there could be one brewing right now. Which do you think the Fed looks at? The perception? Because perception in the, a month ago was everything when it came to that deposit flight.
Right. Yeah, the perception can lead to reality, right? So I think the Fed has to be aware of both. And it can look at regional banks down a fair bit today and say that's kind of a worrying signal. Should we be super concerned about that, or is that normal volatility? Perhaps it's a bit more than normal. So I think the Fed takes that into consideration. Does it really count as an enormous crisis right now? Tough to say. Probably not with the rescues that have been done to date. But I think the Fed is weighing those things pretty carefully.